You know what is fascinating? Quantum superposition from physics, standard distribution from statistics, momentum theory from economics, and sensitive dependence from chaos theory. These seemingly unrelated concepts from different fields can actually create perfect synergy in cryptocurrency trading. Today, I am sharing a strategy that brings together core theories from 4 different disciplines, building a cross-disciplinary market analysis framework. This gives us a completely fresh perspective to examine the true nature of price movements. Hello everyone. Welcome to the Inventor Strategy Deep Analysis channel, where we focus on uncovering the most innovative trading methods. In cryptocurrency trading, traditional technical analysis often limits itself to a single discipline perspective, mainly relying on historical price data to build indicator systems for predictive analysis. While this approach has its value when facing complex and volatile financial markets, single-dimension analysis frameworks can easily create cognitive blind spots and prediction biases. Modern market price movements result from multiple factors working together, involving statistical random processes, physics wave theories, economic supply and demand relationships, and nonlinear characteristics of complex systems. Relying solely on traditional technical indicators often fails to fully capture this multi-dimensional market information. The strategy we are explaining today was designed based on this understanding. It is not satisfied with the analytical limitations of a single discipline, but innovatively introduces a cross-disciplinary theoretical framework. Through organic combination of multidisciplinary perspectives, the strategy attempts to build a more three-dimensional and comprehensive market analysis system, thereby improving adaptability and prediction accuracy in complex market environments. This innovative strategy builds a multi-dimensional market analysis system through 4 core components. First, the statistical component uses z-score standardization to convert the current price's deviation from historical mean into probability values under standard distribution, identifying abnormal price fluctuations. Second, the quantum component borrows from quantum mechanics wave function concepts using Gaussian distribution combined with sine function modeling to capture market price uncertainty and cyclical characteristics. Third, the economic component quantifies market momentum strength and capital flow changes based on logarithmic transformation of fast and slow EMA ratios. Fourth, the Lyapunov component applies chaos theory to assess market system stability, warning of potential violent volatility risks. The 4 components combine according to set weights to form a comprehensive outlook index. Using 50 as the central axis, we judge market tendency. When the index exceeds 70, it triggers a long signal. When below 30, it triggers a short signal. When returning near 50, we execute position closing operations. This multidisciplinary fusion design enables the strategy to simultaneously handle trend following, mean reversion, breakout trading, and risk control, forming a 3-dimensional analysis framework where components complement rather than simply stack on each other. The strategy first defines the core trading framework and key parameters. 7 input parameters constitute the strategy's parameter system. Small length controls the moving average period, simultaneously affecting the calculation foundation of both quantum and statistical components. EMA fast length and EMA slow length define the periods for fast and slow EMAs in the economic component. This ratio relationship determines the sensitivity of momentum signals. The 4 weight parameters embody the strategy's core philosophy. Quantum weight represents uncertainty weight. Economic weight reflects momentum weight. Statistical weight embodies regularity weight. And Lyapunov weight controls stability weight. It is important to emphasize that these parameter default values are just starting points. The real value lies in understanding each parameter's role within the entire analysis framework, then adjusting according to actual needs. Next comes the calculation process for the 4 core components, which demonstrates the specific application of cross-disciplinary theories. First, we calculate basic statistics. SEMA price provides the central tendency of prices, while STED price measures price dispersion. These 2 indicators lay the foundation for subsequent standardization calculations. The statistical component standardizes prices through the z-score formula, which is a classic method in statistics that can convert any distribution into a standard normal distribution framework for analysis. The quantum component design is most innovative. It constructs a Gaussian probability density function, directly borrowing from the wave function concept in quantum mechanics, while adding sign functions to increase periodic characteristics, simulating the fluctuation properties of quantum systems. The economic component calculates the ratio of fast and slow EMAs and takes the logarithm. This processing method comes from the logarithmic return concept in economics, which can symmetrically handle rise and fall amplitudes. The Lyapunov index calculation embodies the core thinking of chaos theory, judging market stability by evaluating the system's sensitivity to initial conditions. The numerical processing in the code avoids zero-value problems in logarithmic operations, reflecting the rigor of engineering practice. The calculation of the comprehensive outlook index is the strategy's core, where we organically fuse theoretical achievements from 4 disciplines. The formula uses 50 as the baseline, and this design has profound mathematical significance. 50 represents the system's equilibrium state. Above 50 indicates system deviation toward bullish direction, while below 50 indicates deviation toward bearish direction. The quantum component -1 processing is because the quantum component's baseline value is 1. This processing gives it the same 0-point characteristics as other components. The 4 components combine through weighted summation of their respective weights, forming a multi-dimensional market assessment indicator. Trading signal generation is based on 2 key thresholds, 70 and 30. This design embodies the significance testing concept from statistics. We only trigger trading behavior when market signals are strong enough. The choice of 70 and 30 corresponds to approximately 1.5 standard deviations in standard normal distribution. This means the strategy only opens positions under high confidence conditions, effectively reducing noise trading risks. This conservative signal design aligns with the professional trading principle of quality over quantity. The strategy execution section embodies modern trading system design concepts. The opening logic uses conditional triggering mechanisms. The closing mechanism design is more sophisticated, using dynamic thresholds rather than fixed take profit and stop loss. Long positions trigger closing when the outlook index falls below 50. With stop loss set at the current candle's low price. Short positions close when the index rises above 50, with stop loss set at the current candle's high price. This design embodies adaptive risk management thinking. Stop loss points adjust dynamically based on market conditions rather than rigidly using fixed percentages. It is particularly worth noting that the strategy does not set fixed profit targets. This allows for greater gains in strong trends, but also requires traders to have deeper market understanding and stronger psychological endurance. The visualization system provides comprehensive data support for strategy analysis. The standardized outlook index adjusts through price scaling factors, enabling clear display on candlestick charts. The 4 components plot independently, with different colors representing different analysis dimensions. Purple quantum component shows uncertainty, orange economic component reflects momentum, yellow statistical component indicates deviation degree, and cyan Lyapunov index warns of stability. Horizontal reference lines include the 50 neutral line, 70 bullish threshold, and 30 bearish threshold. Background colors change dynamically based on the outlook index, providing intuitive feedback for market sentiment. Based on cross-disciplinary design mechanisms, this strategy demonstrates unique adaptive characteristics in different market environments. In clear trending markets, the economic component's momentum effect resonates with the quantum component's directionality, enabling effective trend opportunity capture. In oscillating markets, the statistical component's mean reversion characteristics play a dominant role, combined with Lyapunov index stability monitoring. In high volatility environments, the quantum component's uncertainty modeling advantages emerge, adapting to nonlinear price changes. Common misconceptions include ignoring interaction mechanisms between components, relying solely on single discipline theory for judgment, and disrupting original cross-disciplinary balance structures when adjusting parameters. Advanced techniques involve dynamically adjusting disciplinary weights according to market cycles. Increase statistical and economic component weights in technically driven markets, enhance quantum component weight when emotional trading prevails, and increase Lyapunov component weight during systemic risk periods. We also recommend combining macroeconomic indicators to verify economic component signals and using volatility indicators to assist quantum component analysis. From a quantitative analysis perspective, let us conduct a professional evaluation of this cross-disciplinary strategy. Regarding strategy completeness, the organic fusion of 4 disciplinary theories embodies cutting-edge thinking in modern quantitative trading. Although the quantum component's naming carries conceptual coloring, Its mathematical modeling logic is rigorous. The combination of Gaussian and trigonometric functions can indeed simulate market uncertainty characteristics. In risk management, the dynamic stop-loss mechanism fully considers market state changes, making it more intelligent than traditional fixed stop-losses. However, the strategy does lack position management and capital management modules, which need additional supplementation in live trading. Adaptability performs excellently. Multidisciplinary perspectives enable the strategy to handle complex and volatile market environments. Fixed weights simplify parameter adjustment while leaving room for future adaptive optimization. Understandability is good, with clear mathematical logic for each component. Cross-disciplinary concepts increase learning cost, but also enhance the strategy's theoretical depth. Innovation is this strategy's greatest highlight. Integrating core concepts from physics, statistics, economics, and chaos theory into trading systems represents beneficial exploration of combining quantitative trading with cross-disciplinary research. Regarding practicality, the strategy performs well in most market environments, especially showing clear advantages in moderate volatility trending markets. This strategy demonstrates the innovative potential of quantitative trading, providing completely new thinking for traders seeking to break through traditional technical analysis limitations.